That consumer really likes to surprise us with economic data. It's Thursday, July the 17th, and this is Markets with Megan. If you like this podcast, please subscribe. You can hit that alarm bell, share it with friends, family, or colleagues. But we're here today to go over our economic data like we do typically, and specifically those that can be market moving. Now, since the consumer makes up the majority of GDP, we do really look at some of the consumer spending information that we get on a monthly basis. And this morning we saw the retail sales report for the month of June. This report can be volatile in some instances, and we saw that today. Far surpassed the expectations from economists. When you look at retail spending for the month, whether you exclude autos and gas, it came up 0.6%. Just to put that in perspective, it was only supposed to be up 0.3%. So it basically doubled the expectations. And when you look at what we focus on, what's called the control group, and this is where we focus. This excludes all of those volatile items: food, energy, gas, building materials. These are the things that can be quite volatile, seasonal, and also subject to some price moves. So we exclude those out, and the retail sales control group was up 0.5. Now that was on the back of a slightly modestly downward revision to the prior month where it rose 0.2%, but still beat expectations solidly here for the month. Now, this is great. The markets have liked it. You've seen short-term interest rates move a little bit higher because now we're starting to move into the first Fed rate cut possibly being in December instead of September. Now, we dug this apart, though, because this is shocking to us how resilient this consumer continues to come. The most important thing about this report is to remember that these numbers are not inflationary adjusted. So if you go to buy a carton of eggs last month and you go this month and buy that same exact carton, but it's more expensive, that looks like there was more buying of the carton of eggs, but it wasn't more buying. It was the same amount, just a higher price. It's extraordinarily difficult to nearly impossible to separate out in this report what is inflationary and what's an actual increase in the sales. That's where we rely on earnings season. What are the companies telling us? What are they actually reporting? That's when we look at some of the consumer confidence numbers, business confidence numbers. These all have been very weak and are historically correlated to consumer spending. So we're starting to get a little worried that some of this may be inflationary and showing up from the tariffs before we see it in those headline inflation numbers that we get on a monthly basis. And why do we say that? Because let's look at what drove these numbers higher for the month. When you look at this, motor vehicles and parts, again, could that be tariff related? Food and beverage, general merchandise, apparel. When you look at eating and drinking, at restaurants, could that be service related inflation or a part of that food inflation as well? These are the things when we look at general merchandise, as I mentioned, apparel, these things that we're looking at, importing into the U.S. Are these factors being driven because of higher prices? And will we see that coming out in the consumer price index? We're not quite sure yet. It's too early to tell. Again, this is what we get out of this Markets with Megan, is we dig apart the details of these reports. Now, what do we think from a market-related expectation? We think this pushes the Fed off. We don't think there's enough evidence for the Fed to want to cut interest rates in September. We had been a 50-50 chance. We think that now is much higher likelihood they'll wait until the December meeting. That's all we have today. If you like this podcast, you can get a history of it at marketswithmegan.fm. Thank you.